Every investor dreams of steady, consistent growth, the kind of investing that builds real wealth over time without taking on dangerous levels of risk. But to achieve that, you need to understand one of the most fundamental laws of finance, the relationship between risk and reward. It sounds simple: higher risk, higher potential reward. But in practice, it's much more nuanced. The smartest investors aren't the ones chasing the biggest profits, they're the ones who understand how to balance opportunity and safety. They know that surviving downturns is just as important as riding bull markets. So today, let's explore what risk and reward really mean, how to measure and manage them, and how to structure your investing mindset for long-term, sustainable growth. Let's start with the basics. Risk in investing refers to the chance that the outcome will differ from your expectations, that you could lose some or all of your money. Reward is the potential profit or return from taking that risk. In other words, risk is the uncertainty, and reward is what you earn for taking on that uncertainty. The relationship between them forms the foundation of every investment decision. A savings account has almost no risk, but also very little reward. A volatile stock might offer huge potential returns, but with the real possibility of significant losses. The art of smart investing lies in finding the balance between the two that fits you, your goals, your time horizon, and your emotional tolerance. Let's put it into perspective. Imagine two investors, Sarah and David. Sarah invests her money in low-risk index funds and bonds, earning about 6% per year. David invests in individual growth stocks, aiming for 12% returns, but his portfolio swings wildly, up 25% one year, down 15% the next. After 10 years, who wins? You might assume David, because his average return is higher. But here's the hidden truth: volatility reduces real returns. When your portfolio drops 15%, it takes a 17.6% gain just to recover. Over time, those swings erode compounding efficiency. Sarah's steady 6% compounding quietly outpaces David's inconsistent performance. Her returns grow smoothly, without major drawdowns that destroy progress. That's the difference between chasing reward and mastering risk. Now, how do smart investors manage risk? It starts with diversification. Diversification means spreading your investments across different asset classes, sectors, and geographies so that no single event can wipe out your entire portfolio. It's often summarized in one sentence: don't put all your eggs in one basket. If you own only tech stocks and the tech sector crashes, your portfolio suffers deeply. But if you also own healthcare, consumer goods, bonds, and real estate, those other assets can buffer the losses. Diversification doesn't eliminate risk, it spreads it. It transforms unpredictable, catastrophic losses into manageable fluctuations. Another major factor is time horizon. The longer your time frame, the more risk you can afford to take, because short-term volatility smooths out over years. Historical data shows that while stocks can be unpredictable over a one-year period, they almost always deliver positive returns over 15 to 20 years. That's why young investors can afford to take more risk. They have time to recover from downturns. Older investors nearing retirement, on the other hand, should prioritize capital preservation. Next, let's talk about risk tolerance, the most personal variable in this equation. Risk tolerance isn't just financial, it's emotional. It's your ability to stay calm when markets fall. You could have the best investment strategy in the world, but if you panic sell during downturns, it won't matter. That's why understanding your risk tolerance is crucial. It's better to earn a slightly lower return that lets you sleep peacefully than to chase high-risk returns that cause anxiety and bad decisions. Here's a good exercise. Imagine your portfolio dropping by 20% overnight. How would you react? If that scenario makes you feel sick, you're probably invested too aggressively. If you see it as a buying opportunity, your tolerance for risk is higher than average. Smart investors build portfolios that fit their tolerance, not the other way around. There are also different types of risk to understand. Market risk, inflation risk, interest rate risk, and liquidity risk are just a few. For example, keeping cash in a savings account avoids market risk, but exposes you to inflation risk of the gradual erosion of your purchasing power. On the other hand, investing in stocks exposes you to market risk, but historically beats inflation over time. The goal isn't to eliminate risk, it's to manage and price it correctly. Let's introduce an important concept here, the risk-reward ratio. This ratio compares how much potential reward you get for every unit of risk you take. Traders and investors use it to decide whether an investment is worth it. For instance, if you're risking $1 to make $3, your risk-reward ratio is 1 to 3, an attractive setup. But if you're risking $3 to make $1, that's a losing proposition in the long run. Successful investors always seek asymmetric opportunities, situations where the upside outweighs the downside. In stock investing, that might mean buying strong companies during market dips, when their risk is temporarily inflated but their long-term potential remains solid. Another way to manage risk is through asset allocation, deciding how much of your portfolio goes into stocks, bonds, cash, or alternatives. The right mix depends on your goals and age. A classic guideline known as the Rule of 100 suggests subtracting your age from 100 to determine what percentage of your portfolio should be in stocks. So, a 30-year-old might have 70% in equities and 30% in bonds, while a 60-year-old might invert that ratio to protect capital. Of course, this rule isn't perfect, but it gives a framework for adjusting risk as you grow older. Now, here's something most beginners overlook. Risk can be a tool, not just a threat. Without risk, there's no growth. The key is to take measured, calculated risks that align with your goals. Investing in solid index funds, for instance, carries some market risk but offers strong long-term returns. Starting a business carries risk but can yield life-changing rewards. Risk becomes dangerous only when it's taken blindly, when investors don't understand what they're getting into or let emotions guide their choices. Smart investors also focus on asymmetric risk opportunities, scenarios where the potential gain is much larger than the potential loss. Venture capitalists, for example, invest in startups knowing most will fail. But one success could pay off 100 times over. Retail investors can apply the same logic by diversifying and limiting exposure to speculative bets. Another critical element of managing risk is position sizing, how much money you allocate to a single investment. Even if you believe strongly in a company, putting 50% of your portfolio into it is reckless. Limiting any single position to 5 to 10% ensures that one bad decision won't destroy your portfolio. There's also systematic versus unsystematic risk. Systematic risk is market-wide, like recessions or global events, which can't be diversified away. And systematic risk is company-specific, like poor management or product failure, and can be reduced through diversification. By managing in systematic risk and preparing for systematic shocks, you build resilience. Let's talk about reward now. Reward is not just profit, it's compensated risk. The reason stocks outperform bonds is that investors are rewarded for tolerating higher volatility. The reason bonds outperform savings accounts is the same. In other words, higher risk deserves higher potential reward, but only if that risk is managed intelligently. Smart investors also reinvest their rewards, letting compounding turn moderate returns into exponential growth over time. Earning 8% might sound modest, but over 30 years, it multiplies your money more than tenfold. That's the power of consistent, controlled risk-taking. Let's recap with a few pro tips. Risk is unavoidable if your goal is to manage it, not eliminate it. Diversify across asset types and sectors. Match your risk to your time horizon and emotional tolerance. Focus on asymmetric opportunities where upside far outweighs downside. Always think in probabilities, not guarantees. At the core, understanding risk and reward is about mindset. The most successful investors think in terms of risk-adjusted returns, not just raw profits. They know that survival is the foundation of success because you can't compound if you're wiped out. So next time you evaluate an investment, don't ask, "How much can I make?" Ask, "How much can I lose, and am I okay with that?" That single shift in thinking separates gamblers from investors. To conclude, smart investors don't avoid risk, they respect it. They learn its patterns, hedge against it, and make it work in their favor. When you understand that risk and reward are two sides of the same coin, you stop fearing volatility and start mastering it. And remember, this video is for educational purposes only and not financial advice. Always do your own research or consult a licensed professional before investing.